Well, what in the world, what in the Samhill is going on with interest rates? They keep going up, up, and up. And just what is it that causes interest rates to go up? And is there any relief in sight? We're going to be talking about that today with a very special guest. He's been with us before. It's going to be a great day on the Brian Hirsch Show. Well, good morning, good afternoon, good evening, whatever the time of day it is that you are watching and or listening to today's broadcast of the Brian Hirsch Show. We are so delighted that you have elected to join us. And what is the prevailing topic that is driving today's real estate market is interest rates. Every week we give you an update on where the rates are, and I was a little taken aback at the numbers that we got over the last week, and it's beyond what I can explain to you. So coming to join us today is an expert in the business that will help educate, inform, and edify all of you listening today on interest rates, what's driving interest rates, and what we think the future is going to hold. We're not going to waste any time. We're going to dive right into it. I'd like everybody to please welcome to today's edition of the show, Mr. Craig Lawrence from the Home Depot. What is up, my brother?
What's going on, Brian? How are you?
What is going on? What a crazy time in real estate, unprecedented time in real estate. And it never gets old talking about this topic and where we think things are headed. And people are trying to plan and make decisions for themselves, when to sell, when to buy, timing everything just right. But man, the issue that we have going on right now, brother, is interest rates. They keep going up.
Well, I mean, the reality is inflation is the big kicker. So if you look at what causes inflation, it's just real simple. In simple English, it's supply and demand. So when you have a high demand for products and a low supply, you tend to get inflation, and that's kind of where we're at. And I'm very cynical when it comes to the interest rate market and inflation and things like that. I think COVID was an anomaly, historical anomaly that caused a lot of problems. And most importantly, the biggest problem was the supply chain. So the supply chain for goods like lumber and nails, drywall, all that other stuff really got bogged down. But the demand for housing was still there, but the supply chain essentially cut off the supply. So you had a really crazy time, and COVID really drove the hammer down, the nail on the coffin, so to speak, when it came to the keeping things at a normal pace. The price of homes inflated by a lot. I mean, 40, 50% in some cases. In some cases, it was 75, 80% inflation of the home. So you have that happening. And so the only mechanism that the Fed has is to raise the short-term lending rate. And the short-term lending rate essentially just trickles down to everything else, from the 10-year bond to 30-year mortgage rates, et cetera. So you have this sort of compounding problem that continues to impact the mortgage interest rates. Most importantly, or what's really happening, and you're probably got your finger on the pulse more than I do with this, the prices of homes in most areas keep going up. Slightly but surely, you see a little bit here. Highly desired areas are going up still, or staying up. But the reality is, prices of homes are high. Rates are going to stay high. The only thing that you can do at this point is to lower the demand or increase the supply. Either one's going to solve the problem. Rates are just rates. You can't. There's not much you can do about it on our end. All you can do is hope that the supply factor, the supply equation, gets solved, and that's a problem.
Yeah, so let's kind of walk through everything you just said, and that was a great summation. Let's see if we can unpack a little bit more. You raised an interesting point that things came to a spearhead on the supply side during COVID, because of the supply chain issues that created a crunch with goods and services, specifically lumber, all of the materials needed to build a home. It got a lot more expensive. And so um, it created a bit of a problem in, getting the houses built. To add insult to injury, you also had a period of time, about a 2-year period of time, where money was historically cheap.
Right.
It's like, 2 and 3% mortgage rates. So you're burning the candle at two ends. You have a supply shortage at the same time as you said demand, remained constant. I would argue that demand was higher
Oh yeah.
same period of time, and it caused the prices to skyrocket.
Right.
But
I,
back
I like to add. I like to add to that is that if you notice what's happened 2 years after COVID or 3 years after COVID, there's also the prevailing idea that I think people, I think COVID flicked a switch on a lot of people's heads that, hey, why do I need to save money? I'm probably going to get COVID and die anyway, so I might as well just go crazy. And that fear of missing out thing, that phenomena is still really present. And you can go
okay,
anywhere right now and go to a store, go down the road, go to the mall. It's jam packed, and it's not because people are. I think they just don't care anymore
well,
about conserving.
well, that's a recipe for disaster. I
Big
hope
time.
that we don't end up with, you know, um, that builder generation that survived the depression. They kind of went the other extreme,
Right.
right? Where it's like on the one hand, you say, well, people just don't care about conserving anything.
Right.
And the other extreme is our grandparents and great grandparents conserved everything. I mean, I
Right.
literally, bro, I remember there was some older people in one of our churches that they wanted us to wash and save the plastic utensils
Hmm.
from one of our potlucks.
Yeah.
I'm like,
Yeah.
that's the whole reason we use the
Right.
plastic utensils, is because they're disposable.
Right.
Or you go to somebody's house and they've saved everything. They become pack rats, and
Right.
down to even just little screws.
Right.
And so there's wisdom somewhere in the in between. And so I hope, hopefully maybe people are listening, and sometimes debt is good and sometimes debt's really bad.
Well, I think
And
there's a happy mid. There's
yeah,
a middle that's there, right? And it's
yeah,
still it's there now. If you look at and I have some data from Fred, but if you look at some of the data with house prices, and again, we're talking specifically about mortgage interest rates and how it relates to housing, and the median price of homes in America is going down, and that's what the Fed wants. The Fed wants to drive the prices of homes down to more of an affordable range. And so, and the only mechanism they have is to increase the interest rates. And that's what they've done. They've increased the interest rate. Now, does that impact everywhere? Not really. I mean, in some areas, yes, some areas, no. But some areas are so artificially inflated, it's not even funny. I mean, the high desert is one of them. I think they've removed some of the demand for housing, and we'll see. It's going to take a while for the lack of demand, I should say, to kind of dissipate. So once that demand kind of goes out a little bit further, I think that's when we'll see some interest rates improvement. But I think the long term outlook is going to be 6 to 8 on the range, 6% to 8% range, until they remove all the demand or that supply catches up. And I think the supply aspect is catching up. Going back to the COVID analogy, because COVID kind of really messed the supply up. And a lot of the builders that like down the hill, a lot of those homes are finally being finished. And so a lot of that the supply equation is getting fulfilled. And I think a lot of that will trickle out, and the cycle next year will be a little bit more stabilized.
well,
That's my opinion, at least.
Well, so again, going back to our supply side problem, uh, I just I should have had the graph prepared for our show today, but I just saw one recently. Maybe I'll post something up in the description here in the YouTube channel. But there was a last year, so this is 2022, was the first year in 15 years that we had quote unquote normal building, right? So you're talking about a 15-year time frame. So this has been kind of a ticking bomb
Right.
that has been building over 15 years, where we underbuilt,
Right.
year over year, time out year, I just over and over again. Like here in the desert, you're not going to ever find a house built in say 2009.
Right.
You're not going to find, they don't exist, or 2010, and that's in the wake of the meltdown back in 2007, 2008.
Right.
Wherever, I mean, there was a bunch of houses. You remember this on the west side of town that they had them framed.
Yep.
There was hundreds of
Tear 'em
homes that had
down.
them framed, and they tore them all down.
Yeah. Yeah. Yeah.
I mean, wouldn't it be nice to have those homes now? My
Right.
goodness. So
Well, there's that scarcity effect that you have whenever you roll a lot of bureaucracy into a problem. It really it bogs down innovation. It bogs down the supply. I mean, in our case, how long it takes to get a track home
mhm,
approved and
right,
and even built. It's decades in the making, and you're seeing it down the hill, especially down the hill. Up here, not so much because we're so bogged down up here. Any kind of track home that has to be built not going to get fast tracked. And again, you reduce the supply, but the demand's going to stay the same. In fact, the demand's going to continue to grow
right,
because of population demographics, right? So you're
correct.
going to have the demand there, but the supply is still being bogged down by bureaucratic nonsense that's not allowing these tracks to be fast tracked. Hey, we have 100 units. Let's fast track this and make this break ground tomorrow. That doesn't happen in California governance, and I don't think it happens anywhere in the United States, with maybe the exception of like Texas or some more friendly states that are not so bureaucratic heavy. But in California, we're very bureaucratic heavy, so it gets bogged down in layer 1, 2, 3, 10. It's next thing you know, it's 10 years and you haven't broken ground yet. But that's where they're at down the hill. A lot of those tracks are down the hill that are taking care of some of the supply issues. Those are 10 years in the making.
Mm,
So now those prices, the supply equation, it took that long to get there, and then the builder who originally was probably going to build those houses for 250, now they're selling them for 850, and they're getting premium dollars on these type of things. And so the people who lose out the most is the consumer. The consumer
ouch.
gets really hammered by the bureaucratic morass that happens in California, especially California. It's real bad here.
So, again, this is something that we've repeatedly covered on. If you go back through, I think we're on episode 33 of this show. If you go back, this has been a topic of discussion on a wide array of people that I've had this conversation with on, where are the prices of homes going, where is the market going, and the kind of Chicken Littles of the world saying, hey man, the whole thing's getting ready to crash. The only way the whole thing crashes is if we have a deluge of supply against a diminishment of demand,
Right.
and there is nothing on the horizon that tells us that that's what's coming.
Well,
The supply would either come in the way of foreclosures, or it would come in the way of an onslaught of new builds,
right,
and we
and
don't see
and I
either.
think the problem is that it got driven so rapidly. The prices of homes got driven so rapidly high that it's naturally removing some of the demand. But the problem is that if you look at population demographics, the millennials and the Gen Zs, I mean, there's a lot of them,
Yeah, and
and
they need
they're
a place
all
to live.
they need a place to live. They're all
Yep,
gainfully employed.
yep,
You have a lot of really, generally speaking, it's very good things in our economy are happening right now. Employment's really good. You have the Trump tax cuts, which really impacted people's pocketbooks. I mean, I truly think that if you can tie a lot of the demand for consumer goods is so high was because of one, because of COVID, and two, because of the Trump tax cuts, because he put a lot of money back in people's pockets, and people don't realize it because they're not told this, and there's a reason why those Trump tax they haven't been reverted. So, but the demand that it's created this, they get more, the consumers have more money in their pockets and they have more to spend, and you're talking about you remove the baby boomers, the Gen X, and then you get to the millennials and the Gen Zs, and it's a mass amount of people, and they all know how to consume, and so you have that problem. And without a supply, I mean, the supply for consumer goods is starting to kind of get fixed, right? Grocery stores still now have stuff in them, but the housing aspect, I think it's going to take a couple years before it really kind of evens out. And I think if as long as other states like the Arizonas and Nevadas and places in the Midwest, because there's a lot of building happening in those states, though they're going to help absorb a lot of the supply issues. But in California, it's going to be tough because now that we've reached this peak in price, it's going to be hard to tell the builder like, hey man, you got to roll that down by a couple $100,000 and lower that to sell those things. They're going to struggle with that equation.
Yeah, well, they'll be forced to do it because the market won't bear the price anymore.
That's what the goal is, right? I mean,
yeah,
that's really what the goal is.
I understand.
Is to lower the price. Yeah,
I don't like it. I mean, look, if I had my druthers, the median sale price here in the desert would be around, three and a quarter, 350, and the rates would be somewhere between 3.5 and 4%.
Right.
But I don't get to wave that magic wand. Okay, so you mentioned the 10-year Treasury bond, and I'm looking at an email your CRM sent out about a month ago. How the 10-year Treasury bond influences your mortgage rate. Can you, in terms that a sixth grader can understand, break that down? What exactly is the 10-year Treasury bond? How that correlates to interest rates? The flow of money, how it all happens.
Well, the 10-year bond is really the middle ground for profit, right? So if a bond trader wants to make a little bit of money, he's going to buy the 10-year bond. He's going to sit on it for 10 years and then he'll get his return in 10 years. So it's more of a long-term investment. So mortgage-backed securities are really, they're not 100% based on the 10-year, but there's a big factor is where you look at the 10-year. The basic way to do this is to look at the 10-year bond, add 3 points, and you kind of have the rate for the day. I mean, it's not exact, but it's pretty close. It's like today, the bond is like 4.8. It was at 5 point something one, almost one earlier. But you tack on 3 points and you have your 7.8 rate, which is kind of where they're at right now. And so you can kind of measure the mortgage-backed securities or mortgage rates on that 10-year because it basically envelops the 10-year as a graph. I mean, as a moving mark. We're going to make our money in 10 years. Okay, we can price our mortgage. Typically, a mortgage goes about 10 years for profitability. It'll be sold or maybe refinanced within that time frame. So the 10 years are probably a really good indicator of where they're going to make their money and how they can really outlay 10 years of finance down the line, or the investment, I should say.
And a bond is where the investor is going to loan their money for
to
a
the
rate of
government.
return. Yeah.
Right.
And as opposed to a stock where you're actually taking ownership of whatever commodity it is, you're taking ownership. A bond, you don't have any kind of collateral on it. It's just a loan, and in 10 years it's going to mature.
You have to hope that Uncle Sam does the right thing.
Well, yeah, that's another subject. But and if investors are getting 5% on their money, that's pretty attractive, right?
Very attractive.
So how if you have a slew of investors react to the 10-year Treasury bond by putting their money there, it disincentivizes the money supply going to mortgages?
No, that the 5 year the 5 year return is the yield. So there's an inverse relation to the yield versus what they pay for it. So you really want that yield to be lower. So if the yield is lower, then you make more money that way because it's a longer outlay. Oh, conversely, when you talk about the 30 year versus the 10 year, again, you're looking at the the outlay being a 10 year return rate of return for both the mortgage and the 10 year. So that's kind of how they measure it together. Now for mortgages, like I said, it's not exact science. Look at the 10 year and go, oh hey, yeah, that's how they make it. But it's pretty close. I mean, everybody and I know of, and I've been taught 25 years. Look at the 10 year. Look at the 10 year. So that's really kind of how we look at it. But there's other economic factors involved too, because mortgage-backed securities are just like a stock. They trade them the same way.
I see. So for the consumer that, well, let's deal with two more things before we get you out of here. Three more things, because I'm going to bring you in on the weekly market update to get your insight on the numbers. So the first thing I want to ask you about is the down payment assistance program that, again, your CRM sent out an email saying that you've got a new program available. Tell us about that.
Well, it's a really nice program that allows borrowers in that range of 600 FICO to 639 FICO to take advantage of a down payment assistance program that allows them to borrow money for the down payment. Now, the premier down payment assistance program is always going to be the state of California's product, the CalHFA product, but that cutoff is 640. So from 640 to 700, yeah, there it is right there, access zero. You have the ability to borrow money from the state of California on simple interest, which is very, very good, very inexpensive. So it's the premier program, but there's a large amount of people who don't fit that box, or they don't want a silent second on their mortgage. They would rather have a second that they can pay on. So ours is built very simple, and essentially you're going to borrow up to 5% of the sales price, and you're going to make payments on that on a monthly basis. So whatever the going rate is today for the second is going to be that rate plus 2%. So let's just say that the rate was 8.25% today for the FHA 30. So that the mortgage for the second for the down payment is going to be at 10.25% over 10 years. So it's not a bad deal when you really look at it. As far as how it works and what type of client it can serve. So in our world, we want to be able to impact that 600 to 639 client, because that's a market that really doesn't. There's nothing there for them at this point. There wasn't anything there for them as far as down payment assistance. There are a few, but the costs were astronomical. Like Chenoa was a down payment assistance program for lower range FICOs, but the rate was like 9.5 a week ago, and it's just astronomical rates. But this program solves a problem between 6 and 639, and then above that 640 and above, CalHFA is going to be probably the better product because there is no payment on it. But you also the cost for CalHFA, as far as the rate cost or the closing cost, is also more expensive for CalHFA. So this product doesn't have any additional fees. You just borrow the money from Loan Depot for the down payment and a portion of the closing cost. So you can basically finance a portion of the closing cost, and you come into the home with a little bit of money out of your pocket, or negotiate with the seller, pay for closing costs, whatever the concept is. But at the end of the day, you're able to finance a home with and borrow money for the down payment. So it solves that lack of assets that a lot of people have.
So you go back to grandma and grandpa, great grandma and grandpa, in a way of thinking that was prevalent among that generation. The old way of thinking was you just work hard and you save and you save and you save and you save and you save. until you have 20% for a down payment, which, at a median sale price of 4.25, you're talking about what, close to $90,000
Right.
that you're going to need in cash for a down payment. That doesn't include the closing costs.
Right.
So call it a cool 100 grand. What you're saying is we're doing the same thing as grandma and grandpa and great grandma and grandpa did. Here's the difference. Because
Right.
it's probably going to take you 10 years to save and save and save and save and save and save and save until you have the $100,000.
Right. Or it's 3.5%. So 300,000, that's 10 grand. So, or 10,500. So
Right. No,
for,
I'm talking about with grandma and grandpa's way of thinking.
oh, right. Gotcha.
Okay. So
Right.
it's going to probably take you 10 years to do that.
Right.
So what you're saying is let's move the metric. Instead of 20% is 3.5 plus, whatever the closing costs are. So it's 7%.
Right.
And we're going to take the same 10-year period. And instead of save and save and save and save and save and save and save, you're going to make payments and payments and payments and payments. Instead of paying yourself, you're going to pay the bank. And in exchange for borrowing that time, it's going to cost you a little more money over that time period. But in exchange for it costing you a
And
little
you're
more,
also going to gain
you're going to gain
you're also going
equity
to gain
and you have
equity.
possession of your home.
Right. You can paint the walls
Whereas
purple.
otherwise you would be living with mom and dad or renting some crappy apartment or something like that.
And your money's not at a certain point. The consumer has got to draw the line on, do they want their money working for them, or do they want the money working for somebody else? And if you can convey that concept to people, well, hey, do you want your money working for you? This is how you do it. And if you don't want your money working for you, rent. Because at that point, you're just losing money, and it's not working for you whatsoever.
And that leads me to the second thing I wanted to ask you about. The second of 3 closing questions. To the consumer, well, both to the consumer and to the prospective seller, which theoretically they're also going to be consumers.
Right.
I mean, that's the first question I ask when someone calls me and says, we're thinking of selling our home. The first thing out of my mouth is, okay, where are we moving?
Right.
Because you have to answer that question in order to sell your house is going to make sense. And to those people, thinking about selling because they're also thinking about buying. In a lot of cases, it's out of state, or in some cases, it's a transition of some kind, move down or move up. To those people who are thinking of entering the real estate market and have reservations because of the current market conditions, you would say to them what?
Well, if we're going to say we're moving from Hesperia to Hesperia, right? Well, if that's the case, and you have to make the determination on why you're moving in the first place, and if your money's going to be better somewhere else. Well, if you're sitting on a property, and the question is what I say is simple. Do you have equity on your home right now? And would you like to move that equity to another home that better fits your family situation right now, or your economic situation right now? If that's the case, then it's an easy yes. Regardless of the interest rates, regardless of all that stuff, you can make your money work better at a different place, or you can make your life a little bit better at a different place if you have the equity currently. It's not going to make any sense, obviously. But if you have to move, or you want to change your life, change something about your lifestyle, your house size, any of those things, and you've got equity, your money's going to work no matter where you have it. So if you have $300,000 of equity at house A, you move that over to house B, money's working the same thing, but very likely the house B that you're buying is probably newer, probably bigger, probably more advantages, better location, and unless you're moving to a smaller home, which again makes a lot of sense too, because then you reduce all your out-of-pocket costs for like electricity, gas, location expenses, where that grocery store is. There's lots of reasons to sell a home at this point. It just really comes down to, what do you want to do, the equity that you have in that home? Do you want it to work for you, or do you want it just to sit on your house and not do anything for you? Because right now, if you're sitting on equity, it's not working for you. It's not doing anything. It's just you're gaining equity year over year. At some point, that equity is going to get reduced. So why wouldn't you want to put it somewhere else where you can make it work for you? tap out, put a small down payment on a new house, take that 200 grand that you have left over, put it in a mutual fund or some money market account, make it make money for you, because it's not making money for you now. I mean, you're sitting on equity, it's not making money. It's just depreciating.
What about to the buyer that is currently, renting and they're on the fence, kind of hoping that market conditions improve?
Well, I mean, that goes back to the supply and demand equation. But at the end of the day, the reality is this: is that, do you want your money to work for you or not? I mean, if you want to pay rent, then your money's not working for you, and it's pointless for you to even think of yourself as financially savvy or making financially good decisions, because you're not. Your money's not working for you. So if you're thinking about buying, the number one rule is not to worry about the price or the interest rate or any of those other things. Is to worry about and make sure that your budget for that mortgage payment is where you need it to be to fit your life. If it's not, and you can only rent, then that's okay. That's not a problem. You'll gain better you'll become a better human, get a better job, you'll make more money, and then your budget can change a little bit, or the housing market gets to where your budget's okay. But there's a lot of people in our local economy and even down the hill economy where their money is good enough to own a home, even at the crazy 8.25% interest rate. They can afford a home, but they don't like the mental aspect of, oh, the rate's 8.25%. Oh, my payment is what? That's just insane. Well, the reality is that if you're renting, that your money is not working for you. It's working for somebody else, and he's probably really grateful for you, but he's not giving you a thank you card, or probably even giving you a Christmas gift. But his money's working. Your money's working for him tremendously.
They'll send you a notice to pay or quit if you start
That's
skipping
for
on
sure.
yeah. If you take the 10,000 foot view, and let's just use history as indicator. There were people when I first got into this business in 2011 that would lament that they had quote unquote bought at the wrong time. And what they mean by that is 2005 or 6, when prices were escalating and they were probably paying a 6 to 7% interest rate.
All right.
I think our median sale price in those days was somewhere around 350.
Sounds about right.
When we topped out, and 6 to 7%. And then lo and behold, you've got that bubble driven by artificial demand with just very loose lending standards. So that wasn't a real number, right? All these people buying houses that had no business buying houses.
Oh yeah.
And you got to pay the piper. So you have
but to
this
say, if you look back, if you look, Brian, sorry to cut you off there, Brian, but if you look back at that time frame, we had the same sort of issue with the supply and demand problem.
Yeah.
There wasn't, I mean, the housing tracks that started kicking up in the high desert, they had started those in the 90s. And the supply issue was a problem. And then what they ended up doing is they just opened up the floodgates for supply, and anybody and their brother, you didn't even have to have a contractor's license. You can walk right over to one of those credit unions and get a construction loan to build yourself a non-occupying property, to sell it and flip it. It was just insanity when it came to the supply aspect. But at the same time, they still couldn't keep up with the demand, and they tried with a bunch of, like you said, loose lending standards and a bunch of crazy loans. But the demand issue was really prevalent, and the supply issue is still a problem. Prices went up, but in that time frame, the prices went up to a point where nobody could really afford it at that point. Right? 350 was in the high desert. That was a big nut. That was a big nut at 7%. It was a big nut at that point.
I thought we'd never see it again. Here we are. Higher than that.
Oh yeah, but now it's 600 at 8.25.
But be that as it may, again, just look at the big picture. Let's say that same person that told me in 2011, Brian, we bought at the wrong time. In hindsight, if they're still in that house, they bought at the right time.
Oh yeah.
Right. So it looked like that they bought at the wrong time, and there was an emotional equation where, gee, I bought my house for $350,000 and now it's only worth on the market, $125,000, and I'm $175,000 upside down in my house, and I got screwed. My neighbor's buying the same house for, less than half what I paid for it. They're getting a better rate. I'm in a bad position. They're not in a bad position now if they stayed in the house. And this is where I think that the consumer, they get bogged down a little too much in maybe looking at the short view. This is the long game. Home ownership's the long game. We want to buy that house, start building equity over time. And basically, no matter what you do, this is what I would say to the answer to my own question. What do we say to the consumer, the buyer who's thinking about buying? You really only have three choices, right? You either keep renting, you're taking a risk if you do that. You take the plunge and buy the house, or I guess those would be the two. And either, no matter what you do, you're taking a risk. So
Right.
if you choose to keep renting, what you're risking is that the interest rates don't ever soften, or if they do soften, the prices go up. I mean, I can tell you right now, there's no doubt in my mind, and again, I wish I had the magic wand, that we can get those rates down under 6%, get them under 5%, back to 4.75. Immediately, we're going to see a 15, 18% jump in pricing.
Yeah, I mean, and that would and that's what I think the Fed is trying to prevent. Is they know that they can really make the house. The Fed knows that the demand for housing and demand for goods is there. They know this, but if they lowered rates, it would just, because the supply aspect of things is so screwed up and so messed up and so far behind, that if they lowered interest rates, then nobody going to be able to buy, because that house that you can afford at 400,000 at 7% is now going to be 600,000 at 4%, and the payment still, it's going to be more, right?
Right.
Because
Only you owe
more
more.
money cost, right?
Yeah.
So we're just in a weird, we're kind of in a weird place. But I think the message to consumers and sellers alike is, you want your money to work for you in a budget that is best for you, and how
Yeah.
can you budget your finances without being all crazy about
Yeah.
it? There's the fine line for that.
Well, if you're holding out for the interest rates to come down, then my advice to you would be to buy your house, and when they come down, refi it.
Yeah. Well, yeah. I mean, I mean, I think there's an analogy that I use a lot, is the best time to buy a home was 5 years ago, right? And that's always going to be the case. I mean, even if you bought a home
Yeah.
in '07 and it crashed in '08, that time buying that house in '07 was a good time, because 5 years later you could have sold it for a break-even price, very likely. 10 years later, now you're doubling your money, and you've been paying on the mortgage the whole time, so you really made a lot of money. Generally speaking, you made a lot of money. 15 years later, like we are right now, if you sat on that home for that whole time from '07 to now, your mortgage was probably cut in half that you owed if you didn't refinance and pull any cash out. And now you've got $700,000 or $600,000 of equity that you can use, and take that and put it somewhere that's going to make a ton of money for you. Even if you go buy a trailer in a trailer park, you could take 600 grand and put it into the stock market or into mutual funds or any sort of bond program, and make money off of it over either a short-term period or even a 2-3 year period. You can make a ton of money off that money, and it's smart to do it. Most people don't think about things like this because they're told by social media, they're told by the media, you got to make, if you can't make a buck today, what's the point of doing it?
Yeah, people want that instant gratification, don't they?
They do. They do.
Yeah.
They want that
Make
like button
they
punched.
make decisions, kind of what's the term? When you're in the grocery store, impulse buy.
Impulse. That's right. That's right.
All right, well, let's look at the market update, shall we? Last 30 days sold 325 homes. That's that's slow.
Right. Right.
That's a low absorption rate.
Right.
But look at that median sale price, 4.25. So we talked about in 2006, the last time it peaked out is 350. I never thought we'd see it go that high, and here it is, $75,000 higher, or $75,000 higher. Year over year, last year we sold more homes, And a year ago is when those rates started creeping up, right?
Right.
The sale price was 20 grand cheaper though. I heard it interesting. You said they're coming down in other places.
Yeah, the according to Fred, the website that the government uses, the peak was quarter 4 of 2022 at 479. This is nationally at 479,500. That was the peak of housing median price, and right now, or the end of quarter 2, which was that was June, the price is 416. So median prices are going down, and I've heard that in areas where you can't buy houses because everything's already filled. There's nothing, nobody's really selling anything. So if they have to sell, they have to drop the prices significantly enough in order to compel people to buy in there. So it's a really interesting thing when you look at it. I think that the desert is a great place to buy a home today as compared to what in 07 you're talking about, because in 07 there wasn't really anything here. Now we have infrastructure, now we have restaurants, now we have a lot of really nice features that you would typically desire, or that you deem desirable, like down in Rancho and in Orange County, stuff like that. Most of that stuff is here now, and so we're really at 425 for Southern California. That's really inexpensive. I mean, that's actually a really good price for a home at 425, even at 8% interest rate. It's still a pretty good price for a home. And so I think we're in a good place, although I think most people are just scared of buying at this point.
Well, we're down 10% on our absorption rate, almost 11%, but we're up 5% on our pricing. And what we've got in escrow, got nearly 500 homes in escrow, and the median list price there is 430. So we don't know what the closing is going to be on those yet.
Right.
But if it's trending, then we're looking in the next 30 to 45 days, this number to be closer to this number.
Right.
And then active listings 777. That's our supply problem.
Right.
And the median list price is 460. And then here we are with that current rate.
Right.
Will we see a little bit of relief in the short term on the rates?
It just depends. It really depends.
Shot up a whole point.
Yeah, in about 2 weeks it has.
Yeah.
I don't think the Fed. I don't think the Fed is really being as transparent with people at large. I think because they're very ambiguous with their statements, like, we don't know if we're going to raise rates. It's really possible that we're going to raise rates. They're very back and forth, and the data that comes out, that if you look at economic data, it's up and down, up and down, up and down. Unemployment is very good. That's not good for inflation. There's lots of economic data that is not compelling for lower interest rates. It's just not. I mean, there's just the economy's on fire. I mean, it really is. It's a very heated economy, and until that heat kind of breaks, or the fever breaks, so to speak, then you're going to see more of the same. I don't think they're going to lower rates until maybe, if anything, it'll be first quarter next year. But even then, I don't think that's going to happen, because we're still stuck. Our immediate, as loan officers and real estate agents, we want that immediate gratification too, in the form of a paycheck. But the reality is that we have a long-term problem that's been presented over the last 2.5, 3 years: inflation. And it's going to take a while for that inflation to kind of just ebb out. Now, there's a lot of super positive things that are going to help curb the inflation. You've got the college loans, student loan repayment plans. People got to pay back loans. That helped out quite a bit. Auto workers on strike. That helped out quite a bit. You've got a lot of the tech companies are laying people off because they're just not the same amount of ad space that they can buy anymore. So a lot of I mean, even though it sounds negative in far as humanity and hopefully people having a good time, reality is the fever has to break. So we have to reduce a lot of the demand in the economy, and that'll happen. It's taken a long time, but you have pundits, especially in the political sphere. They know that they need to preach a message of, oh, everything's going to be rosy in the next 6 months. Just watch, just watch, just watch. And the reality is, it's not happening. It's just not happening. It can't happen. The demand is too strong. The supply is too limited. It's just going to take a long time for those two to just kind of even out. And I'm thinking, maybe earliest is 12 months, but more like I'm thinking 3 years, 4 years from now is when they finally kind of level out. And we're just going to be through a struggle for a while until that demand sort of goes down a little bit. And nothing's going to stop the demand because our economy's so good. I mean, the economy's just really, I mean, the Trump tax cuts, man, they were awesome. People don't realize how impactful they were in for W-2 wage earners and how much they have to pay for taxes on a monthly or on a paycheck basis. It's massive, and it's a massive difference. And that's why you don't hear about it. You don't hear about that. The Trump tax cuts, we got to solve that problem, and that's going to solve the economy. Nope, they're not talking about those things because it was really good, really good.
All right, Craig, you're a treasure trove of knowledge and a wealth of information. We so appreciate you coming on. If people want to contact you, the Loan Depot information there, you got a cell number, you got the email address, and the website, and so you can reach out to Craig. But we appreciate you, sir, coming on. And any parting words of wisdom before we get you out of here?
Well, all I can say is if you have the right budget, now's the time to buy a home. If you have the right budgets, now's the time to sell a home.
But I appreciate it, sir. Words of wisdom. Man. Thanks so much for joining us today.
You got it. Talk soon.
Talk to you soon. Craig Lawrence, ladies and gentlemen, and we appreciate him and hope that was beneficial to you, help you get your mind wrapped around what's going on with the interest rates. In closing today, I want to get to our check this out segment of our show. My church, we had a leadership gathering where an activity that we all went to a place called the Exodus Escape Room down in Ontario. Is actually one of our members works there. And so our team went down and we went into this escape room, and basically what it is it's a big puzzle that you have to solve together as a team in real time. Ours was, we went into this mock-up bank, and the whole narrative was that somebody working at the bank was in fact in the mafia and had stolen this very expensive artifact, and it was hidden somewhere in the bank, and our job was to find it. And so you had to figure out, using all the clues in there to unlock things and get to the next clue and get to the next clue. We had so much fun. It took us 50 minutes to solve the puzzle. We had 10 minutes to spare and had the time of our lives. So I highly recommend, if you want to get together with some friends or your family, you can see the website there, exodusescaperoom.com. And there's some facilities all over Southern California and Ontario and Anaheim and other places. Or maybe it was Rancho Cucamonga is where we went. But we really recommend that you go and enjoy that. So we appreciate you joining us for today's edition of the Brian Hirsch Show. We do hope that the information that we give you is helpful to your life. And until the next time we meet, we are serving your dreams. Have a wonderful week, everybody.